Ladies and gentlemen, welcome to a truly extraordinary episode of Stock Market Callus. Today, we have a truly legendary figure in the world of investing, Warren Buffett. He is often regarded as the greatest investor of all time, and for good reason. If you had invested $1,000 in his investment company when it started, it would be worth over $30 million today. Buckle up, folks! This is a journey into the mind of one of the greatest financial minds in history. Let's uncover the secrets, dissect the strategies, and get ready to supercharge your financial wisdom. Let's get started. Number 1. The importance of hiring. So here's a question for you before we dive into this principle. How important do you think integrity is in a team? Warren Buffett places immense importance on hiring the right people for his team, and he's got a clear formula: integrity, intelligence, and energy. He insists that if someone lacks integrity, having intelligence and initiative can be detrimental. Let's break this down. First, there's integrity. Buffett believes this is non-negotiable. You want honest and trustworthy individuals on your team. Why? Because trust is the foundation of any successful partnership or business. Without integrity, you risk not only your reputation, but also your financial well-being. Next, we've got intelligence. Of course, you want smart people on your team. But for Buffett, it's not just about raw IQ. It's about practical wisdom, sound judgment, and the ability to think critically. Intelligence combined with integrity forms a potent combination. And finally, energy or initiative. Buffett appreciates individuals who are self-starters, driven, and have a strong work ethic. They're the ones who take your business to the next level. So when you're building your team or evaluating potential partners, remember these three qualities: integrity, intelligence, and energy. They're not just words. They're the building blocks of success according to the greatest investor of all time. Number 2. Market behavior. Have you ever found yourself influenced by market behavior, whether it's a bull market's euphoria or a bear market's panic? Warren Buffett, often referred to as the Oracle of Omaha, has a keen understanding of market behavior. He recognizes a common pattern among investors. During bull markets, people get carried away by excitement and past gains, often following the herd mentality. Conversely, during bear markets, they become pessimistic, fearing further losses. Now here's where Buffett's wisdom shines through. He firmly believes that this market behavior creates opportunities for savvy investors who don't follow the herd. Let's break it down. During bull markets, the excitement can lead to inflated stock prices, often detached from their intrinsic values. Investors driven by the fear of missing out, or FOMO, jump on the bandwagon without proper analysis. And this is where the danger lies. If you're not careful, you might end up buying overpriced assets, setting yourself up for disappointment when the market inevitably corrects. On the flip side, during bear markets, fear and pessimism can drive stock prices far below their intrinsic values. This is when the savvy investor like Buffett sees opportunities. When everyone else is running for the exits, they're buying high-quality assets at a discount. So what's the key takeaway here? Warren Buffett's approach to market behavior is simple yet profound. Instead of getting carried away by market sentiment, he keeps his focus on the fundamentals. He's patient, disciplined, and unafraid to swim against the tide where it makes sense. Number 3. Investment approach. Warren Buffett, the Oracle of Omaha, is renowned for his investment prowess, and his approach has indeed evolved over the years. He began as a value investor, seeking out undervalued stocks, often described as cigar butt investing. But as he gained experience and wisdom, his approach transformed. Buffett realized that investing in companies just because they were cheap wasn't always a winning strategy. He shifted his focus to investing in wonderful businesses at fair prices. What does this mean? Let's break it down. Cigar butt investing is like picking up discarded cigar butts on the street for that one last puff. These are undervalued stocks that may have been beaten down by the market but might have a little more to give. It's a value-driven strategy, but it comes with risks. On the other hand, investing in a wonderful business means buying shares of companies with strong competitive advantages, often referred to as economic moats. These are businesses that can maintain their profitability and fend off competitors over over the long term. What's the big lesson here? Buffett advises that you should only invest in what you understand. Stick to businesses with clear and enduring competitive advantages, and don't just chase cheap stocks without considering the quality of the underlying business. So, whether you're just starting your investment journey or you're a seasoned investor, remember this. Warren Buffett's investment approach teaches us the value of patience, understanding, and focusing on high-quality, enduring businesses. Number 4. Buy only stocks that you understand. Warren Buffett has consistently emphasized the importance of investing only in what you understand. It might sound like common sense, but it's a principle often overlooked in the pursuit of quick profits. Buy only stocks that you understand means that you should invest in companies or industries that you have a solid grasp of. Buffett isn't interested in complex financial instruments or businesses he can't explain to a fifth grader. So why is this principle so crucial? First, it helps you make informed decisions. When you understand a business and its industry, you're better equipped to assess its prospects, competitive advantages, and risks. Second, it keeps emotions in check. Investing in what you understand reduces the anxiety that often comes with uncertainty. You're less likely to panic and sell during market downturns. And third, it aligns with the concept of long-term investing. Buffett's success isn't built on day trading or speculating. It's about holding on to businesses he understands for the long haul. So whether you're a seasoned investor or just starting, remember this principle. Invest in businesses you truly understand. It's not about being a financial wizard. It's about making rational, informed decisions. Number 5. Learn from mistakes. Warren Buffett, a man who needs no introduction in the world of finance, openly acknowledges that some of his most significant mistakes were not seizing opportunities when he should have. He calls these mistakes of omission, and he believes they are even more significant than mistakes of commission. Let's unpack this. Mistakes of commission are when you take an action, such as buying a stock that doesn't perform well. These mistakes can be painful, but you can often recover over time. On the other hand, mistakes of omission are when you don't take action when you should have. For example, passing up on a promising investment opportunity. These missed opportunities can haunt you because you can't go back in time to seize them. Buffett's wisdom teaches us two crucial lessons. First, seize opportunities when they arise. If you've done your research and the opportunity aligns with your investment philosophy, don't procrastinate. Inaction can often be more costly than making a wrong move. Second, stay within your circle of competence. Buffett emphasizes the importance of investing in what you understand. Trying to venture too far outside your expertise can lead to costly mistakes. In essence, it's not about having a high IQ. It's about being patient, disciplined, and recognizing opportunities when they knock on your door. Number 6. Long-term perspective. Warren Buffett is a staunch advocate of adopting a long-term perspective when it comes to investing. He doesn't sell his investments simply because they may appear overvalued in the short term. Let's break down this principle. Long-term perspective means that Buffett looks beyond the daily fluctuations of the stock market. He's not swayed by short-term market noise or the allure of quick profits. This approach is especially relevant when he owns wholly owned businesses or significant stakes in companies. Instead of focusing on the stock's current price, he zeroes in on long-term cash flows and intrinsic value of these assets. So why is this approach so crucial? First, it minimizes the impact of emotions on investing. When you're constantly checking the market and reacting to short-term fluctuations, fear and greed can take over. Buffett's long-term perspective helps him stay disciplined and avoid impulsive decisions. Second, it aligns with the concept of compounding. By holding on to quality investments for the long haul, you allow your wealth to grow exponentially over time. This is a key factor in Buffett's success. So the big takeaway here is that adopting a long-term perspective in your investment strategy can be a game changer. It helps you stay focused on the fundamentals, reduces the impact of emotions, and allows the power of compounding to work in your favor. Number 7. Intrinsic value. Warren Buffett places a laser focus on the concept of intrinsic value. He defines it as the present value of all future cash flows an investment will generate. But what does this really mean? Let's break it down step by step. First, it's about estimating the future cash flows. When you invest in a stock or a business, you need to project how much money it will generate for you over time. This involves analyzing the company's financial statements, growth prospects, and economic conditions. Second, you discount those future cash flows to their present value. This means you account for the time value of money. Money received in the future is worth less than money in hand today, so you use a discount rate to calculate what those future cash flows are worth in today's dollars. Third, you consider the margin of safety. This is the critical buffer that protects you from errors in your cash flow estimates or unforeseen changes in the business environment. It ensures that even if your projections are a bit off, you're still making a safe investment. So why is intrinsic value so crucial? It serves as a compass in the complex world of investing. It helps you make rational decisions based on fundamental analysis rather than being swayed by market emotions or short-term fluctuations. In essence, it's about buying an investment when its market price is below its intrinsic value, allowing you to build wealth over the long term with a margin of safety. And there you have it, folks, the 7 timeless rules inspired by the investment legend himself, Warren Buffett. Remember, these principles are not just about building wealth, they're about building a sustainable and prosperous financial future. If you found this video valuable, don't forget to hit that subscribe button and turn on notifications. Share this video with your fellow investors and give it a thumbs up if you've gained insights that will help you on your investment journey. Thanks for joining us today. Check out more videos about Crypto Quick Start, your path to riches in 10 minutes, and get rich with stock dividends, real-life success story insights. These videos will help you explore the key concepts of cryptocurrency. Until next time, see you.